With the economy facing high inflation and the Federal Reserve raising interest rates to limit price increases, the U.S. could be headed for a recession in 2023. Building a portfolio that includes at least some less risky assets can help you weather market volatility. In this video, we show you several less risky assets you can start with to build a portfolio for yourself from scratch. We all see from the top of the creators that you might need a big fat bank account to do some investments. But actually, you don't, and we will show you all you need to start some lower level investments. Considerations for low-risk investors. Of course, there's a trade-off. When investors lower risk, they are likely to earn lower returns over the long term. That may be fine if your goal is to preserve principal and earn a steady stream of interest income. Understand your risk tolerance. Although each of the above investments is considered low risk, there is still a sliding scale of risk associated with them. If you invest your money in a certificate of deposit that guarantees a certain rate of return, the risk is much lower than if you enter the world of dividend aristocrats. So that means even if you are a low-risk investor, there will be some risk, so be careful. Know your time horizon. When investing, it's also important to know when you plan to access your money. Certain certificates of deposit, for example, charge fees if you withdraw your money before the maturity date, while you can have your money in a high-yield savings account pretty much immediately when you click a button or visit an ATM. Use your plans for that money: monthly income, down payment for a house in 5 years, income for retirement to determine where you want to invest it. Number 1. U.S. Treasury bills and bonds. U.S. Treasury securities are backed by the full faith and credit of the United States government. Historically, the U.S. has always paid its debts, which helps make Treasury bonds the lowest risk investments you can own. Treasury bills come in maturities of 2 and 10 years. Treasury bonds have long maturities of 20 to 30 years, which means they carry a bit more risk than government bonds with shorter maturities. Interest payments are made every 6 months on both bonds and notes. The U.S. Treasury bond market is the largest and most liquid in the world, so they can be easily sold if you need to dispose of your money before the maturity date. Number 2. Series I savings bonds. I bonds are a special type of U.S. savings bonds with a variable interest rate designed to help keep pace with inflation as measured by the Consumer Price Index. They offer yields based on 2 interest rates: a fixed rate that remains the same over the 30-year life of the bond, and a variable rate that is updated every 6 months to match the prevailing rate of inflation. In addition, I bonds benefit from semi-annual compounding. The value of the bond is increased twice a year by the interest earned, gradually increasing the principal on which you receive interest. You must hold the bond for at least 1 year before cashing it out, and there is a small penalty if you cash it out before 5 years have passed. And if you are in a really high tax place, definitely consider the I bonds because they are a really good option. Number 3. Treasury inflation protected securities. Treasury inflation-protected bonds are issued by the U.S. Treasury and, like I bonds, use a special mechanism to ensure that yields keep pace with inflation. TIPS offers maturities of 5, 10, or 30 years. Most bonds promise to return your original investment, called principal, plus a fixed or variable amount of interest. TIPS offers a fixed interest rate, but their principal value increases or decreases according to the prevailing rate of inflation as measured by CPI. If the principal amount of maturity is higher than your original investment, you keep the higher amount. If the principal amount is equal to or less than your original investment, you get back the original amount. TIPS pays interest every 6 months based on the adjusted principal amount. Number 4. Fixed annuities. Fixed annuities are a popular type of annuity contract used often for retirement planning, but can also be useful for medium-term financial goals. Offered by insurance and financial services companies, it guarantees a fixed rate of return over a specified period of time, regardless of market conditions. There are 2 phases in the life of an annuity: the accumulation phase and the payout phase. In the first phase, you pay a series of amounts into your annuity and receive interest that increases the value of your account on a tax-deferred basis. The payout phase can take the form of either a one-time lump sum payment or a regular series of payments over time. Number 5. High-interest savings accounts. High-interest savings accounts offer an unbeatable combination of a modest rate of return, unlimited liquidity. You can withdraw your money whenever you want. And the backing of the Federal Deposit Insurance Corporation, which insures deposits up to a certain amount. With virtually no risk of losing your money and the possibility of modest returns depending on current interest rates, it makes a lot of sense to park your nest egg, or cash you need for short-term purchases, in a high-interest savings account. And of course, we love those high interests, so use them. Number 6. Certificates of deposit. These time deposit accounts allow you to invest your money at a fixed interest rate for a specified period of time. If you withdraw the money before the maturity date, you'll incur an extra withdrawal fee. There are different types of CDs, such as regular CDs, bump-up CDs, step-up CDs, high-interest CDs, jumbo CDs, CDs with no early withdrawal penalty, and IRA, and different rules and fees apply to different financial institutions. Certificates of deposit are insured by the FDIC up to statutory limits, making them a very low-risk investment option. Number 7. Mutual money market funds. Money market mutual funds invest in a variety of fixed income securities with short maturities and very low credit risks. They typically pay a modest amount of interest, but unlike other types of mutual funds, there is very little chance of making money on appreciation. This type of investment offers a lot of liquidity, and because of the nature of the investments, is considered very safe with little risk of losing money. However, unlike savings accounts or CDs, they aren't backed by the FDIC. These funds are especially great for getting cash, so keep them accessible for major purchases. Number 8. Investment-grade corporate bonds. Corporate bonds are fixed income securities issued by public companies. When a publicly traded company has a very good credit rating, its bonds are classified as investment grade, also called high grade, which means the company is very likely to pay interest over the life of the bond and repay principal at maturity. Ratings agencies such as Moody's, Standard & Poor's, and Fitch assign credit ratings to companies after thoroughly examining their finances and stability. But just because a bond is rated investment grade today is no guarantee that a company won't run into trouble tomorrow and have its credit rating downgraded. For this reason, this type of investment carries more risk than the others mentioned above. Number 9. Preferred stock. Preferred stock combines the characteristics of stocks and bonds in one security. It offers investors reliable income payments and the possibility that the shares will increase in value over time. Preferred stock is issued with a fixed par value. An income from preferred stock receives preferential tax treatment because qualified dividends are generally taxed at a lower rate than bond interest. Although dividends on common stock are reduced or eliminated before dividends on preferred stock may also be reduced or eliminated if the company experiences a loss in earnings. Number 10. Dividend aristocrats. Many publicly traded companies pay dividends, but dividend aristocrats are special. These companies have demonstrated remarkable long-term stability and reliability in their dividend payouts. Yes, both long-term stability and reliability. This one is special, I'm telling you. A publicly traded company is considered a dividend aristocrat if it has increased its annual dividend payments for at least 25 consecutive years. There are other requirements as well. Inclusion in the S&P 500 index, a market capitalization of at least $3 billion. But the key for investors is that these companies have delivered good dividend yields over the long term. Owning shares of a publicly traded company can be riskier than other options on this list, but the dividend aristocrats can also give you reliable cash flow regardless of how the stock market performs, and the chance for appreciation over time. And of course, whatever you want to invest in, keep following our channel for tips and tricks so you never miss out on potential greatness. Also, don't forget to like and subscribe, and we'll see you in other videos. Have a great day, and goodbye.